Hello and welcome to Portfolio Matters, weekly markets checklist, week 173. And great news, Richard is back. So we have the weekly quiz back as well. But before we get into it, Richard will read the disclaimer.
Thank you, Keith, and it's very good to be back. It's been a nice but long summer, and it's getting quite chilly here in London now. So everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this year, this year, I was going to say.
Okay, well, it's been another busy week. The Chinese stock market extended its rally of last week and is now up an astonishing 30% in the year. All of that in the last 3 weeks. Amazing. Japan has elected a new prime minister who's a monetary hawk and is going to encourage the Bank of Japan to keep raising interest rates. The yen rallied, the Nikkei fell. Big news of the week was continued conflict in the Middle East. Israel launched a limited ground invasion of Lebanon, and then Iran fired rockets at Israel. Oil rose very strongly yesterday on suggestions that Israel may hit back at Iran by targeting Iranian oil infrastructure. Jerome Powell has stated that the Fed is not in a hurry to lower rates, and sterling fell after the Bank of England Governor Andrew Bailey stated that the MPC could cut rates more aggressively if UK inflation continues to wane. We'll take you through the latest data. So this is the yen, which leapt versus the US dollar as Japan elected a new prime minister, Shigeru Ishiba. And the flip side of that was the Nikkei fell sharply. The Chinese stock market has had an absolutely astonishing few weeks. So the Chinese government is very keen on manipulating the prices it can. Now, I don't think it's going to succeed in manipulating the house prices in China because the market's too vast, but it can and has stimulated the stock market. In the UK, your energy bills have just leapt by £149 per annum as the new Ofgem price cap came in. That's bad for inflation and for household spending. We've also had this week profit warnings from Stellantis and Aston Martin car makers. Now, Western car makers, we've talked about in previous weeks, are not doing well. And it appears they have invested heavily in EVs and are losing market share to Chinese manufacturers, primarily in China, but also all around the world. And this is iron ore, which leapt this week as Shanghai, Shenzhen, and Guangzhou moved ownership restrictions on Chinese property. And so the iron ore market is anticipating a revival of Chinese construction. We are skeptical. Reminder, Chinese property prices have been in an accelerating decline. There's far too much empty and unfinished property in China. It is difficult to reinflate a Chinese property bubble. And onto this week's economic data. The quick summary: UK is resilient but weak and little signs of strengthening. The latest GDP data revised Q2 GDP growth down. The EU economy is weak and appears to be weakening. The US is strong and the latest data shows it's strengthening. China weak. On to the UK, Richard.
So UK GDP growth quarter on quarter, second estimate for the second quarter of 2024, which has been revised down is therefore worse than expected, 0.5% a quarter, which is annualized just over 2%. So not fantastic. UK GDP growth year on year, this is the second estimate, again, down from the first estimate, 0.7% for the quarter, and significantly down from the consensus estimate, sort of very much bumping along.
Yeah, UK economy not doing great.
We've got UK business investment quarter on quarter is better at 1.4% in the second quarter, and that's up against expectations. And year on year, 0.2%, which again is better than expected, and also better than the previous quarters. Now, the general election hadn't happened by that point, so this may be people thinking we're going to have a decent government, or it may just be one of those flukes.
Well, it doesn't really reassure you about the quality of UK statistics, actually, when the first estimate was minus 0.1 and the second estimate plus 1.4. Not great.
It's not, is it, Keith? Very true. UK nationwide house prices month on month in September up 0.7%, which is significantly ahead of expectations. And our house prices started to rise after a little bit of a period, only slightly, in the doldrums. Although apparently the second home market is softening quite substantially. In fact, a lot of post or mid-COVID second home owners are getting out because they're having to go back to work and offices and so forth. So it's not really working out.
Interesting.
And of course, council tax. But this is the UK nationwide house prices year on year, and you can see that prices have stabilized and have begun to, well, they've actually been rising, haven't they, for the last 12 months, roughly, Keith?
Yeah. They're surprisingly resilient, actually.
Yeah. After a not very big drop. UK Bank of England consumer credit is fairly stable at 1.3 billion. You know, it's within that sort of range that we've had for the last 2 years. Bank of England net mortgage lending is increasing, and that's sort of going up effectively with the increase in house prices, which shows there's sort of more activity in the UK housing market. Bank of England net lending to individuals, again, it's mid-range. It's picked up from the low point in mid to late 2023. UK M4 month on month been flat actually for the last year and a half, nearly 2 years. UK Citigroup Economics Price Index, and that is at no surprise there. I think one can say.
Yes, it's the chart Richard likes least.
Because this is interesting. I haven't seen this for a while. UK Indeed job postings index, and it is continuing to decline, basically, isn't it?
Yeah,
it's sort of flattened out very slightly over the last month, but it is continuing to decline.
Yeah, and it's below pre-pandemic levels.
Yeah. Online job vacancies in the UK are continuing to fall, which suggests that the employment market is becoming softer. And I think online job vacancies is quite a good measure because those jobs are advertised online.
Yeah. So this is just the ONS's data, which they take from Adzuna, and it confirms the Indeed data.
Yeah.
So, UK economy flatlining.
Yeah. And the UK jobs market appearing to be stagnating. So companies neither hiring or firing while workers are staying put.
Yeah. So, because if you look at potential redundancies, I mean, to be fair, that's I don't know what date that ends at 2024, but it seems that employee growth is stalling, but nobody's firing anyone. So it's very similar pattern to the US.
Yes.
And
it's basically people maintaining the status quo as opposed to increasing their workforce. And the British Retail Consortium UK says UK shop prices fell 0.6% year on year in September. And that would actually move them, as commentary says, into deflation.
Good news.
Yeah. And this is showing the inflation situation in the UK. Overall inflation average 2018 to 19, 2.1%. August 2024, overall inflation 2.2%. So, yeah.
Well, that's the worry, Richard, because actually, if you take out the drop in energy, UK inflation would be 3.1%.
Yeah.
So, still way too high. You need.
And hospitality and recreation, I suspect, still trying to recover the additional costs that have been imposed on it, particularly with energy increases. UK pay growth is falling. Excuse me. UK pay growth is falling on the back of lower inflation. Now it's about 4%, which is still high. And these are the estimates of fiscal headroom available to Rachel Reeves under different debt definitions. So, well, pays your money and takes your choice, don't you?
Yeah, absolutely. The bond market is worried about the coming budget end of this month. They're worried that Rachel Reeves is going to borrow a lot more, issue a lot more gilts. We just have to wait and see.
She's going to go for option B, isn't she? 24.9 billion even.
Well, I think if she went for gross debt, the EU measure, that would be, defendable. Right.
Okay, we will see. Yeah, so there's been an awful lot of speculation for things like forever about what Rachel Reeves might target in order to increase the tax take from what is currently a paltry level to a more reasonable level. And pensions, so there's lots of messing around she could do with pensions. Capital gains tax, and basically align it with more align it with income tax.
Yeah.
Dividends likewise, and inheritance tax, removal of exemption for AIM stocks, which all of course, actually I think pretty much all of them militate against savings and
well, all of them hit me and you.
And they militate, they militate against investment. And there's a tightrope she has to tread here, which is she wants to increase investment in the UK economy, and by taking taxes away from people, basically from disincentivizing people to invest in the UK economy and then spending it on effectively non-capital expenditure. I know they want to do some capital. It's a very dangerous thing to do. So we shall have to see.
No, I agree. Well, it's anti-growth, basically.
Okay, debt to GDP arises systematically when the government lacks social endorsement necessary to raise enough taxes to pay for its expenditure. It cannot continue indefinitely. Well, I don't necessarily agree with the FT a lot of the time in their opinion pieces, because they're.
So I know this is my opinion, Richard.
They're I think the okay, sorry, Keith. I think the point about social endorsement here is that the social endorsement has been pushed to the limit, hasn't it? It's not like social endorsement is being awkward. We are taxed at a very, very high rate. And we're not at war, supposedly.
Yeah. Well, this is very high level compared. It's risen so quickly. That's the thing. In 2000, we had a decent debt to GDP level. And now it's 100%.
Yeah, we have Mr. Sunak to thank for that. And Mr. Johnson, I think they take joint responsibility. So summary, horseshoe GDP growth was revised down, and it's not great in the first place. Wage growth is slowing, but it's still well above rate of inflation, and shop price deflation continued. I think is it second month in September, wasn't it? August,
yes, second month. Yeah.
And the UK economy hasn't gone into recession, but it's not strengthening.
Yeah. Actually, it's all the signs are it's weakening. Yeah. Now, that may be seasonal, but it's not looking great. Now, on to the weekly quiz, Richard, which is about the UK.
Okay.
So thank you very much to Wayne J, who put me onto this. Okay. So, question for you. This all relates to the UK's paltry economic growth, okay, which Wayne J sent me an article that put it all down to a lack of investment.
Mm-hmm.
Now, this is the Bristol to Portishead rail link. It is 3 miles long, so not a huge piece of infrastructure. And North Somerset Council are committed to reopening it. Now, it was actually opened in 1867 to connect Bristol to the docks in Portishead, and it was closed in 1963 as part of the Beeching Report, which closed down a lot of UK's rail network.
Beeching Report, I'm just going to chip in here, Keith. Sorry, the Beeching Report is a classic model of don't give a complex technical problem to someone who isn't qualified to make any judgment on it whatsoever, and then enact it. I mean, the Beeching report was a disaster for the UK rail network.
Yeah.
Lord Beeching.
Yeah, well, so the right of way is still there, but no, there's no track and no passengers have ridden on the train since 1964. But they want to reopen it. So today's quiz, Richard, is how long is the environmental assessment for the 3-mile railway link, proposed railway link between Bristol to Portishead, which, bear in mind, the track is already the path is already there.
Laid.
Yeah.
So when you say how long, you mean how many pages?
How many pages? How much does it cost?
So standard type, well, given the nature of your question, Reece, it's not going to be 10, is it? So no. I'm going to plump for 3,200 pages, and I'm going to say the cost was 23 million.
Actually, not bad. Not bad. So 17,912 pages. Okay. Of the 80,000 page planning application. Bear in mind, it's already there. You just need to put the tracks back. Okay. And that is the equivalent of 3.3 miles of paper if it was printed out on A4. Of those, 1,174 pages were devoted to bats. And so my question is, what do you do with this information? I don't think you do anything at all. Yeah, it's 215 pages for newts and 1,810 pages to vegetation management. I mean, it's just a huge box ticking exercise, isn't it?
So, you know, why do our taxes have to go up, Keith? Because throughout the land, public sector is wasting vast quantities of money on this nonsense. I mean, okay, I think newts should be, you know, maybe they need to be relocated, but as you say, they just need to, and they're going to have to dig out the old ballast, aren't they? Relay the ballast and everything. And presumably it's overgrown. They have to cap back the overgrown. But it's just it's just nonsense, isn't it?
The 215 pages on newts. You know, how many miles of railway track have we got in this country? You know, how's this going to be different? Any different?
So I just need to ask a question here, Keith, because I think it all depends whether it's a greater crested newt or the lesser green newt.
Well, I think you should contribute to the report, Richard. They'd love your input.
Doesn't feel like it's quite long enough to me.
You should charge them $100,000. Anyway, thank you very much to Wayne J for all that, because essentially he sent me this piece from ukfoundations.co where they were attributing the relatively poor performance of the UK economy to a lack of investment. We are strangling ourselves in red tape. And so this is gross fixed capital formation, UK, yellow, every other country much better than us. And you know what's happening in the Portishead Railway is indicative of why we can't get anything done in this country. And onto the EU. So we had inflation numbers for September, and they were pretty good, although they missed expectations. Deflation down minus 0.1% in September, bringing inflation down to 1.8% year on year. Below the ECB's target, although core remains high at 2.7%. So when the big fall in energy prices falls out of the comparison window, inflation will be too high. But the ECB is forecasting that inflation will continue to decline, and Christine Lagarde has stated that disinflation has accelerated in the last 2 months and the EU recovery faced headwinds, i.e. prepare yourself for some more interest rate cuts in the Eurozone. Whereas I think she's right about the economy, though. And we look at Eurozone inflation, there doesn't really appear to be that much inflation at all. The inflationary pressures are declining. Producer price inflation month on month in August was poor, up 0.6% month on month, much worse than expectations. Year on year, though, negative. Factory gate inflation, negative year on year, thanks to falling energy prices. We then had the Eurostat surveys. Economic sentiment is dead as a dodo and still negative. Industrial sentiment just keeps on getting worse. That's not a good chart, and it's not headed in the right direction. Services sentiment, if you look at this long term, that's a poor number and it's not going anywhere. Actually, it did tick up a tiny bit, but that's essentially flat. Selling price expectations, they are perfectly compatible with a 2% inflation target. The economic surprise index remains firmly negative. And this is the economic surprise index for different countries. And you can see France and Germany are poor, Germany in particular.
So I know you're not a fan of Peter Zion, Keith, but I do remember when the Russia invaded Ukraine shortly after that huge energy spike, he basically said the German economy is finished. It won't recover from this. So far, that is proving to have been correct.
I think actually a lot of this is to do with China. So if you think about what's happened for the German economy over the last 20 years, they've done very well exporting machine goods to China.
Yeah.
But now the Chinese have used those machine goods to produce lots of high quality manufactured goods, which they're now re-exporting back and outcompeting Germany.
Yeah. Yeah, I think it's a combination too. You're quite right, Keith. China is definitely an big economic threat to Germany.
Well, but your point is that they gambled on cheap Russian energy and it ain't cheap anymore. And that, for industrial sector, that's not good.
The ultimate irony is that not only did they close their nuclear power stations and convert to brown coal, but that everybody else is building or reopening nuclear power stations.
And the latest GDP nowcast shows that the EU economy was contracting in the Q3 just ended, back in recession. And looking at the Indeed job postings, Germany, that's not good. France falling once again. Again, not a happy chart. And the EU employment market, jobs market, has been very strong. So employment's just kept on rising. The unemployment rate has been falling, but the number of vacancies is falling. So some signs of softening, and the economy is not doing well. And when we talk about Germany, real industrial production, this looks like a really bad chart. And you can see that actually the current trend post-COVID is just a continuation of decline that actually started in about 2017. German industry looks to be in serious trouble. And when you look at the forecast GDP, Spain, Italy, even France forecast to continue growing in the coming years. Germany, very little change.
And this is a real problem for the EU, isn't it? Because Germany, up until now, has been the biggest funder of the EU.
In France, the new Prime Minister has put together a centre-right coalition and is proposing a budget that will raise taxes by 20 billion and cut spending to reduce the French fiscal deficit. The socialists, who are the biggest bloc in parliament, have vowed to bring down the government at the first opportunity. Let's see what happens. And I found this an absolutely amazing chart. So French government spending as a share of GDP is about 60%. It just keeps on rising. Basically, that's pensions and, welfare. And
I mean, there's only one way we can get out of that, I think, and that's to have some sort of collapse, because that's the only incentive that will work to change the setup.
No, I disagree, Richard. You need Maggie, privatization, sell off all these industries that are, part of the state. They don't need to be part of the state.
But they won't do that, will they? Without some sort of collapse in the economic system.
So in summary, EU inflation fell below 2% in September. The EU labour market has been very strong, but appears to be weakening. Germany, which has been at the heart of the Eurozone economy since it started in 2000, looks to be structurally weak. And that implies Eurozone growth will be structurally weak going forwards. And that implies the ECB needs to cut rates. On to the US, Richard.
Thanks, Keith. So US PCE inflation month on month is 0.1% in August, and it's at clearly very low levels. PCE inflation year on year, 2.2%, and still the trend is still downwards.
Yeah, and that was lower than expectations. Good news.
And core PCE inflation month on month, 0.1%, consensus 0.2%. Again, very low. Core PCE inflation year on year, basically it's sort of flatlined pretty much for the last couple of months at around about 2.6, 2.7%. US personal income month on month actually considerably worse than expectations, and at 0.2%, and that's quite low. And US personal spending month on month, 0.2% against 0.3% expectation. So that is also down quite low.
We've got a section coming up on revised US GDP data, and they have revised a lot of the data for the last couple of years, and the net effect has been to raise their estimates of GDP and also incomes, etc. And the revised picture is of an economy that is stronger, with consumers having more resources, better paid, higher savings. And so previously we were concerned that US consumers were running out of money and their saving rate was very low. The revised picture is they look absolutely fine, frankly.
So US job opening, it has been now in a downward trend for 2.5 years. And it's still in that trend. It was a little bit up in August, but basically it's still within that trend. And the quits rate is also doing the same thing. In fact, it seems to be steepening slightly, doesn't it?
We reported in previous weeks how consumers were feeling very pessimistic about the jobs market in the US, and that seems to have fed through to them not moving. So they're not leaving jobs.
So the rise in the job openings was due entirely to 103,000 rise in government job openings. So despite their dire fiscal position, the US government is continuing to hire as a whole at an astounding rate.
Yep.
So the JOLTS hiring rate has fallen sharply, and you can see the quits rate doing the same thing. So basically, this is the previous chart, but over a much longer term. And the US labour market is certainly slowing down.
Yeah, surprising actually, because the economy is doing absolutely fine.
Yeah. So, I mean, you could, I don't know whether this is true, but AI is supposed to be a great booster for productivity. You do wonder if at some level there's starting to be a little bit of increasing productivity that is affecting, therefore, the need to recruit people. Now, interestingly, if I can just go on a slight digression, I have started using Anthropoid, which is an AI engine. You can use it for free, or you can use it for $20 a month. And also, you get more if you use it. I'm just using the free one. I put a couple of searches in it yesterday, actually about climate change and carbon dioxide levels over the last 60 million years. And what it does is it trawls through and it produces really quite a cogent analysis of all of
Wow.
the data on it. And I went into some detail on the effect of invertebrate calcification and removing carbon dioxide from the atmosphere. And it gave me consistent, coherent answers on that, which would have taken me days probably to dig up from the internet. So it's certainly, in that respect, it's quite powerful.
Yeah, interesting. Anthropoid. Right.
Anthropoid, yeah, I'd give it a go. Everybody, give it a go. Just it is free. You just have to
Yeah.
give them your email address and then start asking it questions.
Great. Okay.
So this is a chart that shows this strong relationship going back 20 years between the quits rate and wage growth. And obviously the wage growth is lagging the quits rate here. And it looks like wage growth, if this relationship continues, wage growth is going to continue to fall for quite a few months yet.
Yeah, and this relationship makes good sense to me.
Yeah.
Because if people aren't leaving jobs, you're not hiring anyone, then you don't need to raise wages.
Exactly. And the jobs layoff rate is remaining low.
Yeah, so basically nobody's leaving, nobody's joining.
Yeah, the market
Great
is
stagnation.
quiescent. This is the ADP employment change, which was a bit better than expected, but basically it's in that sort of general range of the last 12 months data.
Reminder, non-farm payrolls out this afternoon for September.
One of the most reliable pieces of data produced by the US government.
Yeah, reliably overestimated.
Reliably adjusted in subsequent
Yeah.
months. US challenger job cuts, pretty steady actually. I mean, there's nothing to see here, I would say.
Well, it's saying that it's high by historic standards. So although it's not, particularly elevated, it's higher than pre-COVID average for this time of year.
And challenger net hiring plans versus pre-COVID are significantly lower. Significantly lower. US ISM manufacturing PMI is stable at around about 47, 48, but that is historically on the low side. And ISM manufacturing employment in the US is on a gentle, it's continuing on this gradual downtrend that's been on for the last 3.5 years.
Yeah, that is a poor number, actually.
Yeah. US ISM manufacturing new orders, steady, but not a fantastic level. US IM manufacturing prices paid, it's on a bit of an uptrend. And it is still within that, just within that trend, looking at it, but it's right at the bottom of it.
Yeah, so 48 means they're net cutting prices up. Their net, the prices paid have actually fallen month on month, but
US ISM services actually at top end of its recent sort of 18-month range and moving up quite sharply.
Absolutely. Big bounce. That's a good number.
And the ISM services business activity actually was also looking quite positive.
Yeah.
ISM services employment, that's another one that is on a gentle, very gentle downtrend, and it's sort of within that trend.
So what do you think's going on, Richard? Because the rest of the survey says US services activity was really strong, but actually they're not adding people. Why? It's odd.
Productivity must be improving.
Yes. Yeah.
ISM services new orders actually is sort of broken out of its rather miserable downtrend.
Yeah.
And is looking very strong.
Yeah. That's a good number.
ISM services prices paid I said definitely stabilised, hasn't it, Keith, over the last 12
Yeah.
months? And US construction spending month on month, it's probably always quiet over the summer, isn't it? July and August, June, July and August.
Yeah.
I would guess so.
But weaker than expected.
US initial jobless claim, very stable, really.
Yep.
And continuing jobless claims, the same. Okay, the US Dallas Fed weekly economic GDP estimate is at 2.7%. Last week it was at 2.3%. But I think the takeaway from this chart is that it's quite a stable number,
Yeah.
about 2.5
Yep.
to 3%. And the Atlanta Fed GDP now is at 2.5% this week, 2.9% last week. So they're quite coincident. And the New York Fed GDP now comes a bit higher at 3% this week and last week. And the St. Louis Fed at 1.4, so significantly lower.
Yeah. But basically all in expansion, all doing fine.
Yeah. And the US Economic Surprise Index, whilst it was up slightly on the week, it's at about 0.
Yeah, but it has been negative. You know, US economy has ceased underperforming.
Yeah. And the Indeed jobs posting index actually has flattened out now. So
It
for the
has.
last few months, that has remained steady. Okay, so what this chart is saying that white collar healthcare workers have maintained the number of job postings. White collar ex-healthcare have declined very sharply, and blue
Yeah.
collar workers have declined somewhat.
This may be your AI point, Richard.
It may be, mightn't it? Yeah, interesting. So US truflation, 1.95% this week, 1.43% last week. And actually, that is a change of trend, Keith.
You see the thing, Richard, I'm not sure it is. It's like you had this big step down in early September and big step up at the end of the month. You just ignore that.
Yeah, okay. You have a point
So,
there.
you know, we've stopped reporting UK truflation because it was just nonsense.
Yeah.
I think this is a really important chart, and it explains why the US hasn't gone into recession. So, reminder, when you increase interest rates, what is meant to happen is the cost of borrowing goes up. And so you disincentivize investment, anything that requires large amounts of borrowing. So, for example, buying houses, residential investment. True enough, residential investment collapses as expected, but fixed asset investment didn't. So it just kept on rising. There was no change, no disincentive for business investment. Yesterday, I had my weekly call with US fund manager, and next time I will be doing a piece on data centers. He thinks the answer to this puzzle is huge investment in data centers. And he thinks there's a lot of malinvestment going on in the US. Now, unfortunately, I'm away in Barbados next week, so there'll be no PM next week, but we'll do that section when we return in 2 weeks' time. Richard.
Well, that's interesting, Keith. So I'm not, let's not preempt the session in 2 weeks, but that malinvestment in US data centers, and also presumably the chips, the Inflation Reduction Act and the CHIPS Act have contributed to this as well.
Yes, absolutely.
So in summary, we've got US PCE inflation is coming in about 2.2%, which is roughly target. ISM manufacturing is a bit soft. ISM services came in strong, but we are seeing a reasonably healthy US economy, but with declining pressure on the employment market, and we're wondering what the cause of that is. But the US economy is looking healthy.
Yeah.
And I no longer think the US economy is going to go into recession.
No, I no longer think that either. Actually, I just can't see it.
Yeah.
And on that note, data revisions to the US GDP numbers. So last week, the US issued revised GDP and GDI so gross domestic income numbers for the post-pandemic period. So they've revised the whole data series since 2020. And they revised everything up. So GDP was revised upwards by a cumulative 1.3%. So the US economy has been strong, but it's been even stronger than we've been reporting. And you can have a look at the table at the bottom here. You can see that the biggest revisions were for the year 2022, but the whole period's been revised up. And in particular, we have been talking about GDI, gross domestic income, and how gross domestic income was showing a US economy which was not growing as fast as GDP. And historically, GDI has been a better guide to what's going on in the economy, particularly at turning points. And so when we've been discussing GDI, we've been saying that that may be an indicator that the US economy is not doing as well as the headline GDP number has reported. Well, the revisions completely change that picture. They now show GDI is actually doing just as well as GDP. So the graph on the right is GDI revised, and that's the orange line, and the yellow line is GDP, and they are back in line. And if you look on the left chart, that was pre-revision. And so you see GDI was seriously lagging GDP. Well, that all came down to poor statistics. The revisions show US economy doing well. And previously we had been talking about how poor US savings data suggested that US consumers were increasingly stretched and they were dipping into savings to fund consumption. Well, the revised data changed that picture as well. So when you look at the table at the bottom, which shows disposable income, the seasonally adjusted annualized growth, you see that it's been massively revised up. US consumers, actually, their disposable income has been growing very well. And that's good for the sustainability of the economy. And so the savings rate pre-revision was 3.3%, low. It's been revised up to 5.2%. Still not very high, but perfectly sustainable number. And thank you, It, for sending this chart. The background is US households have deleveraged since the great financial crisis compared to other Western countries. And so their balance sheets were in a good shape. So bottom line is the revisions to the US data now show no inconsistency between GDI and GDP, and they're both being revised up. The US economy is strong, and the revised numbers show it even stronger than we thought, and we thought it was pretty strong.
Yeah.
And on to China. Do you want to do China?
I mean, clearly there's a lot going on in China at the moment, isn't there? They've had their property-induced recession, all sorts of problems, and now they've had a massive amount of stimulus going in.
Yeah.
I think no one's particularly surprised at that, but it's going to be interesting to see how these numbers change over the course of the next few months.
Well, that's right. I'd say these numbers are, fairly irrelevant, frankly. What matters is
yeah, what goes forward.
Yeah.
So anyway, basically the manufacturing PMI has been flat for the last roughly flat for the last 3 years and remains so. The non-manufacturing PMI has been gently falling actually for the last 3 years, but pretty gently, and it's not looking very healthy. The general PMI has basically been flat for the last 3 years.
I should say those are the official numbers, the National Bureau of Statistics.
Yes. So the Kaijin manufacturing PMI is actually showing the same thing, but it's also fallen a little bit in the last couple of months, but it's around about neutral. So all of these numbers are wobbling around the neutral line. The Caixin services PMI doing the same thing, really. And the Caixin composite PMI, again, fairly neutral for the last 3 years. China residential floor space starts has plummeted from beginning of 2022 from 250 million square meters to 50 million square meters now, and it's still falling.
Yeah. And we know the Chinese population is now shrinking.
And that's an 80% reduction.
So this chart shows in orange US house prices and in grey Japanese house prices relative to their peak. So in the case of the US, the peak is July 1996, and prices came down sharply and then have taken off again. Whereas in Japan, they've never recovered. They've just kept on falling, basically. And China, I think the analogy is very much with Japan. Shrinking population, huge property bubble, massive overbuilding. I think prices just continue to drift down.
And also China is in the middle income trap at the moment.
Yeah.
So, what's our summary? Well, Chinese economy continuing to struggle, and the Chinese Communist Party is loosening all sorts of restrictions in order to try and boost the housing market. But the housing market can't be boosted unless the demand is there. And what Keith's point is that demand isn't there.
Yeah. And also, the Chinese consumers have learned that, you buy all these properties off plan and they don't get completed. And when house prices start to fall and also you boost the stock market, the reason that people were buying property in the first place was it was the saving they were allowed, saving instrument they were allowed. Now there are alternatives. Why buy housing? And onto one chart. This is a chart showing the fastest growing occupations in the US. Between 2000 and 2023, the fastest growing occupation was manicurists and pedicurists. Next, HR managers, then meeting, convention and event planners, then massage therapists, then compliance officers. And what you notice about all these occupations is they're service sector jobs that add very little to productivity. So manicurists and pedicurists, that is not a high productivity growth sector. HR managers, I'd say they detract from productivity growth, frankly, just add to costs. Compliance officers, the same. And so when we talk about productivity growth, the productivity growth in the US has been very good, unlike the UK, but everywhere in the West, we are adding jobs in low productivity areas or, frankly, negative productivity areas. And I remain of the opinion productivity growth is heading towards zero.
I think, Keith, you need to be careful what you say here, because our own portfolio matters compliance officer won't like that last comment that you've made.
I fired him a long time ago.
He didn't have a chance to resign.
Yeah. And on to the MPC's Monetary Policy Report 2024, August 2024. This is very short. So basically, what are the Bank of England's latest predictions? Well, first of all, unemployment. I thought this was odd. They're forecasting that UK unemployment will actually continue to rise over the next 2 years. And the commentary was that they're expecting continued tight monetary policy and fiscal policy to result in rising unemployment. So the Bank of England is not expecting to be able to cut rates to stimulate the economy and bring unemployment down. They're expecting inflation to rise towards 2.75% by the end of this year and then fall again in 2025. And the rise in inflation will be entirely due to energy prices, for the fall in energy prices falling out of the comparison window. And when you look at gilt yields, the Bank of England basically thinks that the 10-year yield can be almost entirely explained by changes in interest rate expectations. Market is expecting UK interest rates to stay higher for longer. And now onto the big section of the week, which is the cost of renewables. On the 30th of September, the UK closed its last remaining coal-fired power station at Radcliffe-on-Soar in Lincolnshire. And UK coal consumption, this is an amazing chart, has fallen from 200 million tonnes per annum in the 50s when we had London smogs to pretty much nothing now. And actually, this chart, which still shows some coal consumption for steelmaking, is probably wrong because the last blast furnace in the UK has also closed. And there'll be 2,000 job losses at Holt Talbot in Wales, and the UK will no longer be able to make steel directly from iron ore for the first time in centuries. Instead, we'll only be able to recycle steel from scrap. The UK is moving from burning coal to having more renewables in the mix. So this is the actual electricity generation by source for the year 2023. And so a little bit of coal will now go to zero, but gas, just over a quarter, then solar, wind, hydroelectric, nuclear, biomass. Biomass is chopping down American forests, shipping the pellets over here and burning them. And renewables are forecast to become an astonishing 83% of UK electricity generation by 2050, with the remainder mainly being nuclear.
So this is actually projecting that electricity production is going to rise from, let's say, 320 gigawatts now to 600 and nearly 700 gigawatts in 2050.
That's a very good point, Richard.
So it's going to go up by what, 80%? Yeah, roughly 70% increase in 25 years.
I presume that means because they're assuming that home heating will move entirely from gas to heat source pumps, what's they called?
Heat pumps.
Heat pumps. So this is the carbon intensity of UK electricity generation. Amazing. It's fallen by 60% since 2015. Yeah, we certainly are decarbonising now.
We are in the fortunate position of being able to put a lot of big offshore wind turbines up.
We are.
Which many countries can't do.
Yeah. But UK industrial production has stalled over the same period. Is that a coincidence? Well, UK electricity prices are very high compared to other developed nations. In fact, they are 4 times those of the US. They're about 50% higher than Germany or France. Now, green levies actually compose only about 16% of UK electricity prices. But still, that is a huge handicap for UK industry. And when you look at UK goods exports, they are awful. UK goods exports are at levels last seen during the Great Financial Crisis. And Brexit is obviously part of the problem, but post-Brexit, UK goods exports continued quite strong. So how does UK renewable energy subsidies, how do they work? So there are three different types of scheme. The first of all is called feed-in tariffs. This is mostly used to fund solar generation. And the latest report for 22-23 shows the average total payment was about 3 times higher than the cost of coal-fired electricity generation. Now, all these tariffs are paid by the electricity supplier, who then passes the cost on to the consumer. So we end up paying all these tariffs through our electricity bill. The second one is contract for differences. So there's a price of electricity set, and the government pays, or sorry, and the electricity supplier pays the developer the difference between the agreed price and the price in the market. And you'll see when electricity prices spiked during COVID, the cost of the CFDs actually went negative. So developers were paying the supplier back because electricity was so high. They were above the CFD level. But now suppliers are once more paying developers as electricity prices have fallen. So the cost is £95 a megawatt hour for offshore wind, 73 for onshore, 60 for solar. Total cost in April, in 1 month, was 268 million. But the biggest cost, we're talking 7 billion a year, is in renewable obligation certificates. And these create a market for renewable energy. So generators have to meet a government mandated target, having a portion of their electricity as renewable. If they don't meet it, they have to either pay a fine or buy a renewable obligation certificate in the market. And so pause, take a look. This is how renewable obligation certificates work. Essentially, renewable energy generators are issued these certificates, which they can then sell in the market to generators who are burning fossil fuels. The price in the market depends on the balance between the proportion of renewable energy versus the government's target. If renewable energy generation exceeds the government's target, then the price of those ROCs will fall below the penalty price. But in general, it's above the penalty price. And so renewable obligation certificates are expensive. And we've just had auction round 6 for renewable energy, and having received no bids whatsoever for offshore wind in auction round 5, the government raised its subsidy prices. And you're looking at the blue bars compared to the green bars. And so offshore wind, they rose by 67%, onshore by 52%, floating offshore wind rose by 52%, onshore wind 20%, large-scale solar 30%. And Daily Telegraphs estimates that auction round 6 will add around £150 to household energy bills per annum in the coming year. David Turver thinks the true figure is likely to be about £64 at current prices. Obviously, these extra costs won't hit until those new wind farms and solar farms have been developed. So in auction round 6, there's 5 gigawatts of offshore wind created, 1 gigawatt of onshore wind, 400 megawatts of floating offshore, etc. Enough electricity to power 8 million homes. All the prices, auction prices, were well above the current market price dashed line. So floating offshore wind way higher. Now, one thing I don't understand is that I keep on seeing charts like this, which show the renewable energy levelized cost is at least competitive with gas, and in most cases below it. But if that's true, why is the government having to subsidize the development of renewable energy in this country? And that's not the only cost. In addition to the subsidies, we pay 2.5 billion a year in grid rebalancing costs. And also we have to maintain a whole backup system of gas-fired power stations for when the sun don't shine and the wind don't blow. Renewable energy is not cheap. So the bottom line is UK electricities are expensive and a negative impact on our competitiveness, particularly for energy intensive industries. UK prices, electricity prices, will keep rising as renewables become a larger part of the mix, unless renewables genuinely become cheaper than fossil fuels. So that means household energy bills will keep rising, and that's bad for the consumer and for the UK economy, although it is good for climate change. Now, I've been thinking about the effect of this on productivity. And I had an exchange with an economics professor friend of mine, and he was saying this is a complex problem. Basically, you are replacing one asset, a coal-fired power station, with a new asset, renewable wind generators. The old one had relatively low infrastructure costs, but high ongoing input costs in the form of coal. The new one has high infrastructure costs and low ongoing input costs, i.e. the electricity is essentially free.
It's interesting, Keith. That is very interesting. I mean, so thank you for preparing that. So all of it is fascinating. But I think your conclusion on productivity is actually very interesting, right? So yeah, it makes sense that that it reduces productivity, also that it damages our competitiveness overseas, which is always effectively we've got a carbon pricing tax, haven't we? That other countries don't have, and therefore it's damaging our competitiveness.
Yeah. So when the US has electricity prices which are a quarter of ours, you just can't compete in energy intensive industries.
And yeah, I mean, the other problem which you pointed out is that we have relying on renewables is they are uncertain in terms of their continuity. The cost then is you have to maintain backup power supplies, and that has to be factored into the overall cost of the overall cost. And clearly that adds actually to the loss of productivity that you're referring to.
Yeah,
I mean, I don't think anyone can seriously object to, even if they don't believe in climate change, you can't seriously object to phasing out fossil fuels, because we shouldn't be burning fossil fuels. It's just bad for the environment. We need to make sure as an economy that we don't go faster than our competitors.
Yeah. Well, the thing is, in my mind, we just need to get rid of coal. If we can get rid of coal in the global energy mix, then it makes a huge difference. But, you know, what the UK's done is great for climate change, but it's just nothing compared to, when India and China are building 1,000 coal-fired power stations.
Yeah.
What we do has no effect.
I think we're going to be building Sizewell C, aren't we?
Yes. I think we will be building it for a very long time, just as we have been building it for a very long time.
I think the main issue there, Keith, is there isn't enough paper to actually make the planning application.
Well, given we need to build out the electricity grid, I think the paper shortages are going to get worse. Regular viewers will know that I have been buying REITs, and I've looked at whether it is the right time to start buying UK property. And with that in mind, Great Portland Estates. But we don't have time for it this week because we're trying to get in at 1 hour 30, so we'll do it next time. On to Inflation Watch, Richard.
So data out, we have EU inflation in September was 1.8%. CPI and 2.7 core CPI, both of which down. And in Japan, inflation CPI was 3% and core CPI was 2.8%, both of which are up. So Japanese inflation is rising, EU inflation is falling. Japanese still have an interest rate of 0.25%.
Yeah.
And Goldman Sachs are forecasting that US inflation is going to fall below 2% in early 2025, which is interesting. So output prices suggesting that, because we know that output prices are dropping, so that suggests that the US inflation is going to continue to moderate in line with Goldman's forecast. And Japanese inflation, although the headline inflation is rising, other measures of inflation are actually falling. The trimmed mean is falling.
Yeah.
So Japanese inflation is probably going to continue to fall. So this is possibly slightly out of date since don't have a sustained fall in oil prices anymore. Oil prices are rising on the back of the Middle East, and well, basically war in the Middle East. And had oil prices continued to fall, or Goldman Sachs estimated that it would subtract 0.15% from core PCE inflation. I suspect that's not now going to happen, and that may indeed affect Goldman Sachs 2025.
Yeah, well, I suspect it will happen actually, because unless Israel genuinely does attack Iranian oil infrastructure, and I can't imagine Joe Biden allowing them to do that, then I think oil prices come back down. As I talked about in previous weeks, the oil market looks to be in structural oversupply.
So I don't think that America has any control at all over what Israel is doing.
Right.
And I think that Joe Biden makes these comments knowing that either they're wrong, or at least his team know that either they're wrong. I just think, the US has for a year been saying we're on the verge of a ceasefire. They continue to supply arms to Israel. It's clearly been Israel's strategy the whole time not to have a ceasefire, but to try and take out Hezbollah. Now, I'm not making a comment on that strategy, but what I am saying is I don't think you can place any value on what the US says.
Yeah, don't disagree with that.
So, coming back to inflation, disinflation is continuing.
Thank you, Richard. On to recession watch. Well, US consumers are still not thinking it's a good time to buy houses. So, although interest rates have started to fall, housing affordability is just abysmal at 7.2 times earnings. And we know US house prices have been rising. So, how much of an effect is cutting interest rates going to have on US housing demand? So far, not much. And the mortgage rate remains well above the cap rate. So how much profits you get from renting out houses. So house prices too high compared to rents. Credit card interest rates remain very high, record levels. Delinquency rates continue to rise. Now, we talked earlier about how revisions to the US data showed that US consumers' finances were strong. Well, delinquency rates are poor. So poor people in the US are struggling. And that is confirmed by the annual Fed survey. So this is data for 2023. And it showed that at some stage in the year, 17% of US consumers struggled to pay their bills. Now, if you look at the breakdown between renters and homeowners, renters, over 26% did not pay a bill on time in 2023. So there's a lot of wealth inequality in the US. And if you are renting and on lower income, you are struggling to pay your bills. Car manufacturers, we talked about Stellantis and Aston Martin earlier. Well, car inventories have been rising. So they've been building more cars than they can sell. at some stage they're going to have to cut production. No wonder manufacturing is not looking great in the US, because this suggests they're still overproducing.
Yeah.
Now, this is the correlation between the JOLTS job openings data and the US household survey on the left and employment construction and construction jobs on the right and job openings in construction on the right. So Michael Sarwan of Nordea is forecasting the US unemployment rate will continue to rise and will reach about 5.5%. So in summary, poor US households continue to struggle. There appears to be little danger of a US recession, but the jobs market is soft. It's odd. And often a soft landing watch, Richard.
So we've got data here which is showing that inflation surprise index is falling and the economic growth data surprise index is rising. In other words, inflation data is subsiding and growth data is increasing, which is what a soft landing would consist of. This is a chart that shows global semiconductor sales grew 18.7% in the year to July, and there's no sign of a fall in global semiconductor sales. And the red line shows year-on-year change, and the year-on-year change currently is around about 20%, 20% positive. So a lot of semiconductor activity, and we've got US investment growth, which has slowed slightly, very slightly, but is actually remaining pretty positive at around about 5%.
Yeah.
As we've looked at all the other US data this morning, there's nothing to indicate any particular economic weakness that is going to push the US into recession. And I think that it has survived interest rate hike, and interest rates are now falling in the US. And therefore, I think the chances of a recession are actually quite limited. And I believe personally that the chances of a more generous Fed and the easing of financial conditions is more likely, particularly since the US government has a problem in funding itself.
Yeah, I completely agree. On to other charts. So when Richard talks about the funding of the US government, well, the difference between the blue and the green is how much the Fed is paying out to US banks every day in the form of additional interest. They are making huge profits on the back of interest rate rises.
The Fed is paying huge amounts of money to the US banks for their deposits at the Fed, and that interest comes out of tax revenues. So ultimately, the US taxpayer is paying vast sums of money to US banks to maintain their profitability.
Yeah. Yes, absolutely. And on to good news. So this is what 20 years worth of spent nuclear fuel looks like. Safely stored at Maine Yankee Nuclear Power Station. And the energy produced from this fuel avoided 70 million metric tons of CO2 emissions. So, everyone talks about the dangers of nuclear, but, there are vanishingly few deaths from nuclear power station. It's reliable. What's not to love, basically? I think we should, if we're going to transition away from fossil fuels, nuclear has to be part of the mix. On to equities, Richard.
Thank you, Keith. Okay, so this is our equities checklist. So just having a quick look down I'm going to pick out some highlights from the weekly change. So Hang Seng was up 9.9%. That clearly is a consequence of the Chinese stimulus. Bitcoin was down 6.5%, and the VIX was up 31%. Going down the year on year, the FTSE All World is up year to date. The year to date, FTSE All World is up 16%, and the All Share is up 7%. And then S&P 500 is up nearly 20%, as is the Nasdaq. The Hang Seng 32%, but that's because of the Chinese stimulus recently. The TOPIX Japanese index is up 14%, Bitcoin is up 44% year to date.
Yeah.
A US dollar, sorry, pound versus the dollar. The US dollar is quite low at the moment. We're sort of toying with, is it going to fall below 100 on the dollar index? But the pound against the dollar is up 3% over the year.
Yeah.
And the VIX actually is up 64% over the year, but the VIX is still very low. So let's go off to the FTSE All World Equity Index.
Yeah. Poor week, but good year.
Yeah. The FTSE All Share, actually, it's been flat since April. And the Euro Stock 600 has actually also been flat effectively since April.
Yeah, it just absolutely mystifies me. The German economy going nowhere. Eurozone doing poorly. Why is it market up 8%? Mystifying.
Because it's the only game in town, I think, probably, Keith. The S&P 500, I mean, seriously, up 20%. And completely unaffected by the increase in interest rates, looking back. NASDAQ up 20%, although it hasn't really moved very much in the last couple of months over the summer. Well, it has been quite volatile, in fact, but it hasn't gone up. The Russell 2000 has been quite volatile over the last couple of months, but
yeah. So my prediction that the NASDAQ was forming a double top, that didn't work. Maybe it's a triple top.
So, Keith, I'm now of the view that the NASDAQ and the US stock markets will continue to rise. And they will continue to rise because effectively the Fed's going to have to fund the US government deficit.
Yeah. Well, I mean, clearly I've been totally wrong. And I still don't understand why, basically. Because
so I've been totally wrong as well.
Well, yeah, in the case of equities, and let's talk about equities and bonds. So bonds and equities are both claims on financial instruments and claims on future cash flows, and they should be priced on those future cash flows. So if the price of a bond falls and its yield rises, so you are discounting those future cash flows at a higher rate. Now, that means if equities, there's no change in the future expected future cash flows of equities, their price should also fall. Now, what's happened in the US is equities have been absolutely off to the races this year, up 20%. So what's going on? The only way that works is if there has been an offsetting, more than offsetting, rise in expected future cash flows. And I just can't see it.
Or there has been a reduction in people's expectation for expected future cash flows, i.e. they are discounting at a lower interest rate.
But then bond yields should fall.
Yeah. I mean, so what I think, I agree with you, Keith. This is somewhat logic defying, and I think that if you look at the graph of money supply or Fed balance sheet versus the NASDAQ, they're synchronous pretty much. And I think that, or is it US debt? Anyway, those graphs that show the synchronicity between the NASDAQ and the US fiscal position. The US fiscal position is going to continue to get worse. And therefore, the correlation is that the US stock market will continue to rise. And it's a little bit like it is in fact an inflationary effect, isn't it? As a country suffers inflation, its stock market rises. It doesn't necessarily increase your purchasing power, but increases your absolute.
Yeah, well,
so if you look at a graph,
for me.
if you look at a graph of the US dollar versus gold since Nixon took the US off the gold standard, the US dollars are down around 95%.
Yes, no, I completely agree.
Which is effectively debasement. So I think what's effectively happening is all these fiat currencies, the pound included, are being debased, and the consequence of that is these asset markets continue to rise. I think that's what's happening. There we are. There's the Hang Seng and Chinese easing.
Well, you've got a very good point, Richard. I don't think that's based on fundamentals. That's chucking liquidity into the market.
Yeah. And topics, Bitcoin. Bitcoin had its big rise from October, November last year up until the spring of this year, and it's been flat since then. And there's the pound against the dollar, which is in an uptrend, which actually is slightly problematic if you have US dollar investments, because it's obviously you're fighting against the tide, as sadly I have. And I don't hedge them.
Right.
There's a euro US dollar, effectively is doing the same thing as a pound dollar. And the dollar index flirting. Oh, it's up at 101 now. So, but it's been flirting with 100, and it hasn't broken it. So
yeah, US economy is strong.
Yeah. And there's the VIX below. This chart doesn't really show it, but historically, over 5 or 10 years, it's at a low level.
Yes, agreed.
And global equity market breadth has improved even.
Yeah.
Which means more participants in the increase in the rise in the market than on the MAG 7. US equities tend to be volatile pre-election and then a rally post-election after the uncertainties are out of the way. It was a hypothesis, it's fair to say. US equity valuation ex-TMT are high but not extreme. Obviously, it's the TMT companies which are pretty high. And the US equity market is now almost 50%, half of the world stock market, so as big as everything else added together. And it does have 24 of the world's 25 largest companies. The US is a powerhouse of an economy. The AI bubble has definitely deflated, hasn't it? And probably continue to deflate without actually damaging the stock market as a whole, or the economy as a whole. And I think AI, probably is a good investment. We have to be very careful about your timing and the companies you invest in. Can I digress onto AI, or is that not appropriate? So I was listening to a webcast the other day by a guy who does know quite a lot about AI, and he was saying the problem is that these generations of AI, they have to train them on virtually all the information that's known in the world. And one is time consuming. Two, it's very expensive in terms of electricity consumption and obviously processing power. And three, when there's no more information to train them on, you can't train them anymore. And we're reaching those limits.
Wow.
And he said that to train a 5th generation AI model will cost about $200 billion. And what's the return on it, was his question.
Well, absolutely. Because the thing is, I use Google, and these days when you type a question into Google, an AI answer comes up, and that's free. And frankly, my trust in it is quite low currently. So I don't use it at all.
In fact, I wonder whether it's possible to drive Anthropoid into a depressive state by asking it what its future is. Okay, so this chart shows that analysts have been walking down their Q3 earnings estimates, which you would think would have an impact on the stock market.
Yeah, none.
But they're still bullish on 2025. This is like having a cake and eating it, isn't it, Keith?
It is. We've talked about this loads of times. I just don't know where that's coming from.
US corporate profits to GDP, pre-revision and post-revision. So actually, profits to GDP around about 13%, which is higher than the historic average, but not extraordinarily high. And US equities are expensive, 22 times forward PE currently.
So the thing is, Richard, I agree the US economy is, looks like it would just keep on growing, given that the US is going to cut interest rates. Equity prices just seem ridiculous to me. Compared to bonds. Bonds seem cheap. When you look at just the price of future cash flows, the price of equities relative to investing in the risk-free rate seems too high. That doesn't mean they can't go to infinity, but
no, I agree with you. Unless something happens to the profitability of US companies, it's pushing the bounds of believability, isn't it? So if profitability goes up, well, that obviously means that GDP has to grow substantially, and
Yeah.
you end up. I mean, that you have to have a basis for that expectation.
And I go back to that chart, one chart, jobs growth in the US,
Yeah,
manicurists, HR
but
managers, compliance.
yeah, but at some point, is AI going to start to dramatically increase productivity? That's my question. And if it does, then some of our assumptions start to
Yeah.
break down.
Okay.
So this is interesting, isn't it? So tech IPOs have dried up. Is that because they're asking for a too high a valuation and people just aren't prepared to stump up? I mean, I noticed OpenAI is valuing itself at 150 billion.
Yeah, I know. I saw the valuations. So, the UK Revolut was being valued in the FT at 48 billion. That's just like very high private sector valuations.
Yeah. So long Mag 7 is a very crowded trade. And short Chinese equities actually was really a very bad trade, wasn't it? Probably not
Yeah,
so crowded as it was. Not so crowded now, Keith.
well, that's true.
Wouldn't
But
laugh.
actually, that bounce in Chinese equities was that a short squeeze.
Can I just comment here about my own fallibility, which is, if you recall, I was long China large caps,
Yeah.
and I was neatly out of China large. It's an ETF, the China large cap ETF, well in advance of this bounce.
Yeah. Well, we'll talk about my year later, but you all know what it's like.
So the price earnings ratios of Mag 7 are much better than tech stocks were during the dot-com, because actually the Mag 7 do make money.
They do. They make very good money, actually.
Yeah.
Okay, thank you, Richard. On to commodities, and generally a very strong week for commodities, particularly energy. Oil bounced hard on Middle East tensions. Industrial metals were generally strong on Chinese stimulus. Precious metals have had a great week, a great year, but last week there's a little change. So on to energy. So Brent was up 9% on the week. Natural gas, we're entering winter, so Dutch natural gas futures up 4%, US natural gas futures up 8%. Coal and uranium both rose as well. So this is Brent. Big jump on the back of worries that Israel will start targeting Iranian oil infrastructure, but you'll notice that's still well down from its highs on the year. Structurally, the oil market is in oversupply. I did a podcast on this. If you're interested, please take a look. This is WTI, similar story. And the general weakness in oil markets comes despite continued recent drawdowns in US inventories. US crude production is at 13.3 million barrels a day, below the peak of 13.4 million for the year. And the EIA has been forecasting strong growth towards the end of this year that has yet to occur. The Baker Hughes rig count fell by 4 and is down 16 on the year. And this is Goldman Sachs's forecasts for the oil price under different scenarios. They see risks skewed to the downside, as we have been talking about on this podcast. Take a look. Natural gas futures, we're going into winter. Gas prices in Europe are rising, same in the UK. US natural gas futures actually rising quite nicely. And we know a lot of new LNG export facilities have come online in H2. Will that rise be sustained? Uranium has actually ticked up a little bit, but well down on the year. The bull market in uranium seems to have stalled for now. But the US has opened a couple of new nuclear power stations. Hurrah! After a long time of not building any.
So I think, can I just comment on uranium?
Yep.
So I think there are a couple of points there. One is, I believe that generally speaking, at the current uranium price, most uranium miners, operating uranium miners, are now profitable.
Yeah.
And secondly, as I think probably a lot of people know, that the uranium market is substantially driven by these long-term contracts that the power generators enter into. And so the spot price is not really a reflection of what's going on in the long-term contract market on its in sense of its day-to-day movements. But the other point I would make is that this is the price for unenriched uranium, and obviously then having purchased the unenriched uranium, it has to go through an 18 months or 2-year process of enrichment, and then the enriched. So the enriched before it could be used in the power stations. So the other source of potential profitability in this market is in enrichers as opposed to miners.
On to industrial metals, Richard.
Thanks, Keith. So a fairly quiet, well, actually not a very quiet week, was it? So the ones that moved significantly, as Keith mentioned earlier, iron ore has had a very powerful week. Again, that's on the back of the Chinese stimulus, although it's down 24% on the year. Lithium down 22% on the year, but we had a reasonable week this week. I mean, this is all tied up with electric vehicle demand, I think, isn't it? Nickel, I mean, presumably again, nickel and tin, consequence of the Chinese stimulus, I suppose.
Yeah, I assume so.
This week. I mean, the only standout there, I think, is that tin is actually up 32% year to date, and copper was up 16% year to date. Although copper's been a bit in the doldrums recently. So there we have aluminium.
Yeah, well up from its lows.
Yeah. Iron ore.
I just don't think that's going to be sustained.
I don't think so, because it needs the Chinese property market to sustain it, doesn't it? And we don't think that's going to happen. Nickel.
Yeah, we know there's a flood of nickel coming from Indonesia in the coming years. I just don't think that's going to be sustained either.
No. And there's tin, which is, looking quite a strong chart, actually. It looks like it is,
yeah.
Break out of that, doesn't it?
Yeah, getting rid of lead in solder, so it's all tin, means there's a fundamental bid for tin, and it's very rare in the Earth's crust.
Right, yeah. There's zinc, which is doing very well. Precious metals. So moving on to precious metals. Gold up 30% year to date, silver up a little bit more, 33% year to date. Platinum almost 3%, rhodium up 6%, and then palladium down 17%. So the platinum, rhodium, palladium really not participating in the rise of gold and silver. And I think the rise of gold and silver is simply the monetary metal issue, whereas platinum, rhodium, and palladium, a lot of their increase, their demand is related to catalytic converters and industrial demand. So there we have the chart of gold, which is actually showing pretty consistent rise now for the last 12 months.
Yeah, amazing. Well done, Richard.
Chinese gold, I haven't seen this, is interesting, isn't it? Chinese gold volume has exploded on the Shanghai Futures Exchange. Indian gold imports, apparently India have reduced import tariffs on gold, and it has resulted in their citizens buying more gold.
Yeah. And
the correlation between gold and real yields started to break down, didn't it, a couple of years ago, as you can see from this, and it is it's continued to break down substantially.
Yeah, all the kind of correlations that I previously had relied on are just completely collapsing.
And there's silver, which I think looks ready to break out on this chart when it gets above gets a little bit above 32.
Thank you, Richard. On to rates, and it's been bloody awful, frankly. UK rates, this 30-year is now for over 4.6%. And we've had UK inflation that's come in soft. Bank of England talking about if UK inflation continues to come down, how it can cut rates faster. We've had the shop price inflation in September is negative. Wage growth also coming down, but real yields are rising. So very poor. And I've been stuffed In the case of US, this looks like a much more normal yield curve to me. Now the US 30-year is what, 4.2, 4 point, whereas the UK is 4.6. And what's happening is the UK is suffering from an extended Liz Truss moment, basically. The market is clearly worried about what the Labour government are going to do on the 30th. When you look at, this is a 10-year, the US 10-year has been coming down over the last 6 months. German, the same. UK, flat as a dodo. Sorry, dead as a dodo, not flat as a dodo. Anyway, now this is chart from the FT. It shows real yields. So back to 1985, and the UK 10-year yield is positive, having been negative for the whole period post GFC. But his point is, it's still a long way below where it could be. Now, I would say that whole period is the Bank of England gaining inflation fighting credibility and growth slowing. And I'm expecting that trend to resume at some point. But so far, it absolutely has not happened. And in the last 10 years, bonds have been an absolutely abysmal investment, worst run since the 1960s. So this is the UK 2-year. It's been rising again. And that's a big rise, actually, in the course of the last few months. Odd. 10-year. So the market is clearly worried that the Labour government is going to cause higher inflation. And this is the 30-year. Absolutely disastrous for me. Very, very depressing. Long term, you can see that highest 30-year yield since pre-GFC, quite a long pre-GFC. This is the US 10. Unlike the UK, yields down a lot over the past year, down from 5 to 3.8%. Whereas when you look at the UK, barely moved. Concluding comments. Well, oil has risen strongly on the back of Middle East tension. The US economy, revisions to the data show it is strong and there's very little sign of it slowing. Disinflation continues. How have you been doing, Richard? I hope you've been doing well.
Thank you, Keith. Yeah, well, I have been doing well because the price of precious metals has been doing well. Obviously, as I alluded to, the pound has gone up 10% against the dollar. Most of my precious metal investments, obviously including them, are denominated in dollars. So that has been a headwind to performance. And the other thing that's been a headwind to performance actually is that the gold and silver mining shares that I own haven't performed as they historically have when the price of gold has risen. And I think I am basically sitting on my hands on that, waiting for that to reverse. And I've just actually, as we were doing this, I just had a quick look at one of the big inputs into gold and silver mining costs is energy, and which is obviously very closely linked to the price of oil. And whilst the price of gold has risen very substantially over the last couple of years, the price of oil hasn't changed effectively. It's fluctuated, but it hasn't changed. So actually, the energy cost has remained constant, which suggests to me that the extraction costs have remained constant, but the return in terms of the value of the material they're producing has gone up quite a lot. So we should start to see significant profitability coming through these companies. And I think at that point, there will be a turn in investor sentiment towards them. And that's what I'm waiting for.
Yeah.
How about you, Keith? How have you done over the summer?
It's been absolutely terrible. So last week I was up a little bit, probably giving it back this morning, down 9.2% year to date. That includes, so I've got loads of inflation linked instruments, and I've made a bid on the inflation link, and even after that, I've lost 9.2%.
You don't count your dividend, your
Well,
dividend.
I do. Yeah, no, everything's in there.
Oh, right. Okay.
So, I mean, it's terrible. We're the worst year I've ever had. Very, very depressing. Now, this week, I've continued my recent strategy of selling down short-dated and cash-like instruments and buying REITs. So, essentially, I am I've been buying income. And talk about this, how REITs, both the NAV and the discount to NAV are linked to interest rates. As interest rates go down, the NAV rises and the discount falls. So that should give them a double whammy as interest rates come down and I get income. And so essentially, I am future-proofing the portfolio. So I've lost a lot of money, don't want to lose any more. And going forwards, I can live off this portfolio indefinitely, assuming that REITs don't go bust or, there's no problem with the underlying. Now, this is, T68. And frankly, this last turn down has been just so depressing in that, I thought we were now moving into an upward channel and that the gilt prices would rise, i.e. yields would fall as, inflation in the UK is coming down and the economy seems to be slowing. Oh, it's mystifying, just very depressing. And so, but what I've been buying these infrastructure trusts. This is Pantheon Infrastructure Trust, and some of them are taking off. So price has been rising very strongly. Now, sadly, it's done this before and then collapsed, but I bought it. It's at a 24% discount to NAV. It had very good results, dividend yield, best part of 5%. And I've also done very well out of this. This is a life science REIT. It's at a huge discount to NAV, though the NAV has narrowed. Its results were last week, and it is paying a dividend. And it believes that it's started to turn a corner, that its lab investments, the occupancy is rising. So again, bought some of that. And this one, thank you very much to Dan Leeds 1980 for recommending this. This is residential secure income. It owns residential care homes. It is closing. So it is going into drawdown. It's selling the assets. The last NAV was at 83p per share. The current share price is 58. So if it manages to sell the assets at, let's say, 80p, then you're going to get a 35% return. That's the trade. So very illiquid. I bought some and hoping that it manages to sell at close to NAV. So thank you all for watching. It's great to have Richard back. Reminder, no Portfolio Matters next week as I'm on holiday yet again. Last holiday for a while though. I hope you're all doing better than me. I'm having a terrible time, very depressing, but we carry on. So please press like and subscribe to the channel, and it's goodbye from Richard Wheater.
And it's goodbye for Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website. including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.